This episode is brought to you by Indeed. When your computer breaks, you don't wait for it to magically start working again. You fix the problem. So why wait to hire the people your company desperately needs? Use Indeed's sponsored jobs to hire top talent fast. And even better, you only pay for results. There's no need to wait. Speed up your hiring with a $75 sponsored job credit at Indeed.com/podcast. Terms and conditions apply.
Reality radio for a really great future. We're talking real money.
Well, we want to thank you all for continuing to support the crappiest stocks in the world with your with your money. Thank you so much for continuing to give us something to talk about. Because here's the deal. Think about this for a minute. I was thinking about this before the show started. Oh, hi, I'm Don. That's Tom. This is Talking Real Money, the podcast. What would CNBC do if they truly espouse the same types of beliefs we do, that markets are efficient, that nothing beats diversification, that there's no point in trying to time the market or beat the market because there is no effective strategy to do so? What would they fill their day with on CNBC if they didn't believe that or if they didn't, I don't know that they even believe it, espouse buying the hot stocks and timing the market, all of this stuff? What would they do?
Yeah, they would rerun the Dan Solon interview they did when he took on Jim Cramer like 18 years ago.
No,
it's been a long time. But
they would probably just rerun more Shark Tanks.
Yeah, Shark Tank
Shark
again.
Tank.
Shark,
Oh, it's
1987.
a Shark Tank marathon. Because the reality is, many of you, thankfully on our podcast, not as many of you as elsewhere, still labor under the mistaken belief that you can pick what's hot and avoid what's not, that you know when to get in and when to get out, and that there are signs like, you know, that PE ratios are high or whatever it is. This stuff is all an illusion, and yet we continue to believe it. And what do we do with like these Redditors, for example? They're back again.
Yeah,
I mean,
all of this is as big as it's ever been. It hasn't quite got the headlines it did in 2020, in 2021.
Well, but that was COVID, wasn't it?
Yeah,
I mean, really, we were bored.
Yeah, that's true. And I mean, the Standard & Poor's 500 is at record highs.
Yeah.
Meme stocks are back. We'll talk about that in a minute. Options trading never been bigger than ever right now. Then you want to throw in cryptocurrency among that, but listen to some of the numbers. It's astounding. Palantir, and this is one of the meme stocks.
Okay, now we're talking about the meme stocks.
Yep, this is a meme stock.
Palantir is the only argument.
I read up on it. I don't know what it does.
The only argument I can find for it, it's a strategy advisory company that uses AI, and I think the only argument you can find for it is that it's one of the few publicly traded AI stocks, or at least companies that rely heavily on AI. So those who are excited about the potential for AI are buying up Palantir because it's either Palantir or NVIDIA.
Well, but what about the fact that they rely a lot on government contracts for their revenue? I mean, isn't that a kind of a
I would not be relying on any government anything right now. I was talking to my daughter the other day, who's got a friend who works for the National Park Service, and I said, "Is she afraid for her job?" And she goes, "Well, no, there are only a couple of them in her department." I said, "But they're going to get rid of the department."
Yeah, that makes it tough. She should go on a long hike and hope that the checks still get deposited. But here's the thing. So Palantir stock is up about 60% this year. Its PE ratio. Now, I've never even heard of a PE ratio this high.
For those of you playing along at home, price to earnings ratio.
Yeah.
That's the number of times its price can be divided by its earnings.
Yeah. And have you ever even heard of a number this? Now, there are stocks that have no E, right? Okay.
Yeah, right. There are lots of no E stocks. Well,
and they exist. Yeah.
GameStop, I think, maybe.
Well, we'll get to that in a moment. Their price to earnings ratio, 655. When I saw the number, I thought
they got to do a lot more earning to justify their price. It sounds like
I've never even heard of a number that high. But that's just kind of the warm up. I mean, you've got MicroStrategy, which I guess
they changed their name to Strategy now. Yeah,
because they don't want to be small anymore; they want to be big. The market cap on Strategy, $87 billion, which, as you know, is a stock built on Bitcoin. But the market cap is twice the value of the Bitcoin they hold.
But the reason being they're borrowing to buy additional Bitcoin.
Let's lever up.
Right.
I mean,
so
sure.
they have doubled the Bitcoin, and people are pricing it as if they actually owned that for cash.
Yeah.
And I want to correct something. GameStop does have earnings.
Oh, I was just going to
They're trading at a 133 PE. Much bigger deal, a much better deal than
buy that. But then there's Chewy up 9.
Hey, they sell dog food
in the last 12 months. BlackBerry. So I'm going to go haul mine out. I still have it at home in my desk. I guess it's coming back. I guess I'm going to be getting rid of the the iPhone. I'm going to get rid of that. Move right back.
Oh, and by the way, just for BlackBerry, their earnings are a loss of 25 cents.
Oh, well, okay.
So they have a negative PE. Yeah, so they have no E.
That doggone E thing. So you have that backdrop. You have the Standard & Poor's 500. And then what else has been big? Well, prediction markets, betting on everything from, as people did on Trump's election, on Federal Reserve meetings, that people are betting on the Los Angeles wildfires. What impact they would, people were putting money down on all kinds of weird, mysterious, and really dumb bets there. And then speaking of really dumb, the one that we've touched on before, which I just absolutely abhor, which is getting children into it, which is getting people's money that they might use for some actual important thing. Sports gambling, DraftKings, FanDuel, they're outreaching, and the leagues themselves are outreaching for people to get them to gamble up as well.
At least when compared to the prediction markets, they don't call themselves the sports markets. I mean,
good point.
That prediction market makes it almost sound legitimate. It's not. It's still the prediction casino.
Yeah, and if that wasn't enough, then you read about in the last year, just 30% of actively managed global funds beat their indexes in 2024. That's in 1 year. Right, if you start going back a few years,
the farther back you go,
give us an example.
The worse they look. As a matter of fact, hold on, let me pull up the latest SPIVA.
Yeah, which will give you some real numbers.
Standard and Poor's Index versus active. That's what
and
SPIVA
before you give that number,
for.
People have been voting with their feet, right? There's now $22.5 trillion in passive exchange-traded funds and mutual funds. And we're not going to get into what is passive and what is active, but people have decided that those active managers that you mentioned aren't going to get any better in the future because they haven't been any better in the past, right? The numbers prove that.
Well, S&P, because they use their indexes, they're using the S&P 500, and this is just large cap funds, not all funds. So they compare apples to apples. In the last year, 43% of active funds outperformed the S&P 500. Not bad.
That's different than the number I just gave out from Bank of America.
Because this is just large cap.
Correct. Yep.
However, we just go out 3 years, and that number is 14%.
Yeah. And you have to pick those in advance, by the way. You don't get to pick them
afterwards. You got to pick them in advance. And
so
over 10 years, it balances out to about 15.
Okay. So, again, but pretty small number considering.
Well, considering the fact that not only do you have to get it right now, but then you have to pick the fund that outperforms because they don't necessarily follow. The best performer in 1 year is obviously not the best performer in the next year.
That's a bit of a problem. You're right. But here's the problem with indexing that I see that seems to come up time and time again. Again, when I look at many of your portfolios, that people pour money into index funds, and we recommend indexing. Yes, that's a good approach. It's low cost. It's diversified. But most people put the money into, and it's now the largest exchange-traded fund funds like VOO, the S&P 500, which keeps buying those big, huge companies, which keeps them going up and up and up, right?
Right.
When they should be diversifying out into other types of stocks, smaller companies, value companies, international companies, emerging market companies, REITs, if you really want to get diversified. That's the issue I see overall, is that people's asset allocation, while at one level is good because they're giving up on active managers, that's terrific. But they're still piling money into one part of the market, the part that's gone up the fastest, the part that's dominated by these huge companies, and the part that, if the future looks like the past, when the pop comes, will be impacted most greatly by that, right?
Yeah. Oh, see, that's the thing. That's why I believe it's so important to have, and Tom too, we all believe that those who believe in science and facts and research and study, we believe that the only way that you can be in the right place at the right time when it comes to building a portfolio is to be in all the places, or pretty much all the places, pretty much all the time.
And most of you are not, because you trust the Standard & Poor's 500. It's easy to buy.
All the places, all the time. That means international. That means you want small. That means you want value. That means you want emergings. That even means you want, I hate to say this word, bonds.
Yeah, I know. You're going to get struck down. You're going to get smited here soon for even mentioning them. So yeah, you got to be diversified. But part two of that still is this aspect, and I'm going to be on another podcast to talk about this later this week, but not gambling, actually investing, because all those aforementioned things, individual equities, even the S&P, putting it all in there, really is a gamble. It's a bet. It's saying, here's what we expect will be better into the future. Yes, and sports betting is a total gamble, and prediction markets, even bigger gamble. I mean, that's just pure gambling. Whereas if you invest in the global economy, it's paid for many, many years. We don't know the future, of course, but we don't want you to be in individual stocks. We don't want you to be in sectors, and we don't want you to be in ideas, because there's new idea every doggone day. Those are two of them. And then I still think the other one, Don, the reason that most people fall into these traps is they hear something, they fall into recency bias, and they ignore the longer term. They hear the noise and they get caught up with that and pour money into things that are going to end in a bad way, in my judgment.
And let's turn it completely over onto the other side and look at the safest place, the things that will never end up in a bad way. But you'd think, for example, if you're managing a government bond fund portfolio, you would think that given all your expertise and knowledge, you'd be able to kind of be in when rates are about to fall and be a little bit out, or shorter maturity when rates are going to rise. You know, you could predict that, right? The percentage of actively managed government bond funds that outperform just owning the index of government bond funds is what number would you just guess? How many, what percentage would you guess outperform this ability to, by picking interest rates and knowing when to get in and when
I'll say it's 20%.
Okay. You want to lower that?
I'll say it's 10%. How's that?
You want to lower that
5,
again?
going once,
you
going
want to lower
twice,
that again?
3, 2, 1. Really?
0.
This gets back to the negative E aforementioned, right?
0. Not
0.
in
Wow.
10 years. Not
10 years.
One single actively managed government bond fund managed to outperform just owning bonds.
Yeah. Which,
wow,
I didn't even believe it. You had to give me the number, right? Because I always think
0.
hope springs eternal. There's somebody out there that's
no,
smart.
not a soul could do it.
We shouldn't have let the bond king retire, I guess.
Well,
He
now,
would have
see, the bond
fixed us.
king was playing with junk and
Yeah, he did a
leverage.
whole bunch of stuff.
This is just general government bonds. So,
Yeah.
but I
Anyway,
find that
so-
fascinating. They couldn't even beat the interest rate guessing game.
Yeah, which people are trying to do every single day. So learn. Pay attention to the lessons from the past.
Don't watch CNBC.
Thank you. As you said, what would they run?
And send us your questions at talkingrealmoney.com on the Contact Us form, just like this person did.
Yeah, Brian from Portland, Oregon. We recently sold a large position in our brokerage that was invested in VT to use for a home down payment in the next 2 to 3 years. Well, first of all, that's good. You should not be in a all stock portfolio if you're going to use the money in the next 2 to 3 years. He says it was about 50,000. Do you have any thoughts on where to park this money for the short term? Hoping to get your opinion on SGOV, which sounds like a government exchange traded fund from Schwab. That was my guess. I didn't look it up.
No, it's iShares. You were close.
Oh, pardon me. iShares.
Yeah. iShares, it's the 0 to 3 month Treasury ETF.
All right. Hold on to that one. How about HYSA?
Oh, I know that one. That's a high yield savings account. Yes, that's what that is.
And then how about SPAX? SPAXX. We've talked about that before, I think, but
SPAX.
That's also a government money market.
That's
fund.
the Schwab Money Fund. Yeah. Okay. Schwab Money Fund.
Okay. So,
all right. So
what's your opinion? Where would you go?
In terms of safety, high yield savings accounts are probably number one in terms of you're not going to lose any money as long as you stay under $250,000.
Not going to break the buck.
Yields are very high. You could still find some right around 5.
That's pretty good. Short-term money.
The bond fund can fluctuate in value and has. SGOV, it doesn't fluctuate much, but it has gone up and down just a little bit. I mean, it's gone from $100 a share to as high as $100.75 and as low as $99.98. So
there's a little bit of volatility.
It ain't
not much. No,
the money market fund, no volatility, but the money market fund does have securities that aren't full faith and credit style securities that do have some, albeit incredibly low default risk.
All right, so give Brian a straightforward, easy answer. Which one?
I would just go with a high yield savings account for the next few months.
Which is the HYSA.
No, that's what I just go find the highest yielding HYSA.
Just go to bank rate, look it up, get the highest number today. Go ahead and put the money in there, and you're going to get 4.5% or something today, which is pretty good money for short term stuff.
Yeah. I mean, let's look. I mean, this is going to be a little bit old by the time this airs, but.
Not too big a change, hopefully, but one never knows.
Let's see what the highest rate going these days is. They're down a bit. The highest rate I'm finding now is 4.5.
I think that's what I just said. So
that's the highest one. Oh, wait, 4.75. Sorry.
Okay.
Found a 4.75. And then, of course, hey, if you really don't care about your money and you don't care about making any, you can always go to Bank of America and still get 0.01.
Gotta love them.
Or Chase. They're very competitive, these two.
Cassandra writes us from Sebastian, Florida. 10 years ago, my advisor financial guy told me to drop $62,000 into this annuity. It's been there for 10 years. It costs about $1,400 in fees, and it's up to $99,000.
How many years ago?
10. I think my
terrible
payout,
return.
Yeah, I know. I think my payout's going to be around 72. There's a 10 years ago that my financial guy told me to drop. He repeated himself. Anyway, it's been there 10 years.
Yeah.
Has a cost of $1,400. I think the payout's going to be 72. There's a death benefit, but once the payment begins, the death benefit goes down to 0. If I live that long, then there's a death payment. I'm wondering if I should start my payments. I'm going to be 73 this year, or I should cash it out and put it in something like stocks and bonds. I don't know what to do. In other words, been in this annuity 10 years. You're right. The growth rate has not been very good.
1,400. So 90,000?
99,000.
100,000.
Says Cassandra. Yes. Yep.
Okay. And the payout is not $72. It's $7,200.
No, the payout's going to be around when Cassandra's 72.
Oh, do we know what the?
Nope. Don't know the payout number. Nope.
The annuitants.
Nope. So it's kind of hard to say because the payout would be the critical part of all this. Death benefit, but I want to separate that out just for a moment because people conflate these things. And if you need insurance, then go buy insurance. I wouldn't hold this for that feature because you could go buy something term. I mean, at 72 or 73, who are you still supporting that may need a payout if you're dying?
You shouldn't care about that part. Is moot. That point's moot. You don't need to deal with that.
I got a 17-year-old, so I got to have some, but most people don't. But
my guess is that your annual payout on this thing is going to be somewhere between $6,000 and $7,000 if you annuitize it. If you turn it into an immediate, 6 to 7, somewhere in there. That's probably about right. But bear in mind, now you've given up the 100,000. You no longer own the 100,000. Now you could invest the $100,000 in high yield savings, bonds, a CD ladder, whatever it might be, absolutely safe, and probably get back about $4,500.
Yeah, right. So
a year,
less,
but you
but the
still
money's
own
yours.
the 100,000.
Yep. And then anything happens to you, you get the full amount back.
Right, or your estate does.
Yeah,
or your estate does.
Yep.
So those are two relatively safe possibilities with the money, given your age. So it really depends on, do you need that higher income? Is that the thing that's most important to you, or would you rather own the 100,000 and have a slightly smaller income?
Yeah. Or if you didn't even need the money, would you take it out, invest it in stocks and bonds, and leave it for somebody else?
Maybe. Yep.
Yeah, because then you don't really want to have it in cash-like instruments. So a lot to think about there, Cassandra. All right, this question, this is the farthest away question maybe ever. I don't know, but it comes from Rumia, Poland.
Wow.
Yeah.
I don't even
says
know where
it's
Rumia
from
is
Dawid, Dawid. I don't know. Am I pronouncing that right? I guess. I'm not sure.
Dawid?
Dawid?
Oh,
Okay.
it's David. It's like David. David.
Okay. I didn't want to mess it up. So, says, hello, cheesecake lovers.
Investment
Reference to
pornography.
previous cheesecake. Yeah. This is your biggest fan from Poland. Recently, Avantis launched 3 UCITS ETFs. So now we Europeans can invest like you.
Yay!
Avantis Global Equity, Avantis Global Small Cap Value. I know and understand that Avantis employs smart people who catch real value in stocks. Question: how can I know that in 20 years there will be equally smart people working there? Investing in a pure passive index, I know we'll get there in 20 to 30 years. But here, Avantis, I'm starting to wonder how it will look in the future.
It's because, see,
That's a good
it's
question.
not, it's okay. But what we're doing, and this is a problem, I really want to sit down and talk with these guys from Avantis and Dimensional about finding new branding. They are still holding themselves out to be active managers, and active management implies smart people. No. There is not a group of smart people actively tweaking the portfolio at Avantis or Dimensional. There are smart people who created the formula for investing. Smart people like many Nobel Prize winners, Robert
Correct.
Burton and Eugene Fama and Harry Markowitz and Paul Samuelson. And
does it matter? In other words, does it matter in 20 years?
Because the rules
correct.
will persist no matter who the people are. And really, you want to have smart people who realize they're not smart enough. See, the smartest people are those who realize they're not smart enough to know anything about the future.
It's fascinating, too, when you get to talk to them, because a lot of the people at Dimensional and Avantis have been around long enough, and they were some of the smartest people that were working for some of those firms, and then went, wait
exactly.
a minute, it doesn't
work.
Yeah, I got to do something else here. And by the way, back to the active management, there's never been, ever, more smart people trying to trade markets than today, working for all those actively managed funds, and they're doing worse than they ever done.
Well, as that was our point earlier in the podcast.
Yeah.
The smart people, really, those who believe they are smarter than the market, are failing miserably. And that's why I attribute a much higher level of intelligence, because, I'm one of them. I attribute a much higher level of intelligence.
You guys meet on weekends or something?
We're really super intelligent. We're too smart to think we're smart. That's it.
I really appreciate
We're too
that.
smart to think we're smart.
So
super smart people don't think they're super smart.
That's true. But back to Avantis, this is a rules-based investing house, if you will.
The rules may change over time.
Yeah, they might.
We have seen rules. It's an evolutionary process as opposed to a revolutionary process. But for example, at Dimensional, their first factors were small cap and value.
Yep.
Small companies and undervalued stocks.
Market exposure, then small, then
value. Okay, yeah. Being in the market first, just being in stocks, and then small and then value.
Yep,
so
that's right.
Stocks make more money than bonds.
Yep.
Small cap has made more money than
big,
large, and anyway. So, but then they have added a few things, minor tweaks. For example, their research did, despite the fact that they didn't want it to. They really didn't want it to. They did not buy the concept of momentum, that you can factor in a stock's momentum as something that will carry it forward and quantify what momentum means. Dimensional said it is a factor based on our past research.
The stocks that are going up keep going up
for a while.
Yeah.
And here's one that came up later. You would have thought this would have been maybe number one.
This was the duh?
This was the biggest duh of all.
I guess
Guess what they recently, in the past decade or so.
Decade or
so. Guess what factor they discovered really influences how well a stock's going to do?
How much money the company makes?
Yeah, profitability.
Oh, yeah, okay. Yeah,
profitability.
Does make a difference.
Really. The more profitable companies make more money. Who would have thought?
So they've screened
But their laws, their rules.
Correct. They've screened more companies out. They emphasize these other companies to a greater extent, but it's still rules-based. It's not active in that smart people are picking stocks or picking sectors or any of that.
And let me give you a great analogy for you scientifically inclined
Thank you
out there.
for sharing that with us. Oh, great one. We really appreciate it.
No, here's a great analogy.
Okay.
The laws of physics over the past hundreds of years or even thousands have been considered at each step along our evolution to be immutable. That there can be that these are the rules, these are the laws of physics. Turns out we keep finding things that break the rules. A perfect example is computing versus quantum computing.
Yeah.
Don't tell me you understand quantum computing.
Because it's all about reading up on it.
The computers, it's all about the fact that this little bit of thing, I don't even know what to call it, can be two different things at the same time. It can be like a cat and a dog simultaneously.
That's scary, man.
Yeah. So
I don't want to know.
And they're computing based on this, and it actually works. Don't know how, but it violates the old-fashioned laws of physics that a thing can only be a thing.
Yep.
So remember, rules can change, but it's rules-based, so therefore the rules have to be robust and well-tested before anybody like Avantis or Dimensional is going to use them in their current form. Now, can they change down the road and say, well, you know what? We'd rather be like PIMCO.
Sure. Could happen.
They could. Yeah. Would they? It would destroy their niche in the marketplace.
It'd be hard to understand. It'd be difficult on their business because most of their business is with advisors who have trusted them for what we just described. So, yes, it would be a difficult direction to go. But that's a good question.
Thank you for all those great questions. Those are all wonderful.
And if you've got one, guess what?
What?
We want to answer it. Tell them how they can ask. They can
tell them how they can win, Don.
Yeah,
well, all you have to do is go to talkingrealmoney.com. That's talkingrealmoney.com. And click on the button, the thing that says contact us, and then contact us with your questions. Or if you prefer to talk with us live, every Saturday from 3 to 5 p.m. Eastern Time, we'll be live on the radio taking your calls at 855-935-TALK, 855-935-8255. Now back to you, Tom.
Thank you very much. Take advantage of all of that. And we appreciate you being part of the pod. Thank you. I'm glad they finally found work for you. We appreciate you being part of the podcast. We do. So thank you.
All right. Thanks for being there. And thanks for joining us in this very important quest to get all of America talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Apella Wealth, a fee-only registered investment advisor. Please see Apella Wealth's ADV Part 2A on our website for information regarding Apella's fees and services. Apella Capital, LLC, DBA Apella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Apella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.